Are you sure?
Here's the 30-second lesson on what legends know. Never ask a bride why she's getting married. Don't wear a skirt on a windy day. Deodorant is not a shower. Don't sniff chili flakes. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, and once again we have come to that season of the year where we discuss GDP data. Now the thing is that for Q1 of this year, the data is going to come out next week, but the data actually comes out after the recording of next week's episode. So what we're going to do for you instead is analyze what all data we have and try to come up with an answer of what the economy looks like in Q1 and possibly what the Q1 data that will come out next week will look like. To do this analysis, as always, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, let's set the context for Q1 first. What was the growth like earlier? What is the global condition like? And what has been the impact? This was the quarter that saw the election. So what has been the impact of the elections?
Yeah, so to set the context, so the economy grew at 8.2% in the previous financial year.
Right.
And in the fourth quarter, that is January to March quarter, the economy grew by 7.8%. So now we also have projections by the RBI and by the Economic Survey for the full financial year. The Economic Survey was more cautious in its outlook, and the survey suggested that economy would grow at around 6.5 to 7%. In this financial year, in this financial year as a whole, and RBI's projection is for 7.2%, and RBI also gives quarterly projections. So, as per RBI's projection for quarter one, growth is likely to be 7.1%.
Right.
That is the April to June quarter of the first of the FY25. Now we know that typically what we see is that across all years, if we try to analyze the GDP data, we'll see that the first quarter generally shows a sequential easing. Normally we see Q4 having the maximum growth rate.
Right.
And in terms of the share of the various quarters in the annual GDP, the share of the first quarter is the lowest. So, and the economic activity then picks up in Q2, then further in Q3, and then it peaks at Q4. So that is one factor, and that could get further compounded this year because of general elections, because of elections related uncertainty, lingering heat wave, and also due to sharp slowdown in government expenditure. So we can see the fiscal data, hardly any expenditure took place during the first quarter.
Because of the election.
Right. So these reasons or this backdrop has to be kept in mind when we analyze the first quarter GDP data. So that's the backdrop.
Right. Okay. So now that we've set the context, let's first look at the industrial sector. What are the various the data that we have for the industrial sector? What is it showing? How did Q1 go?
So when we talk about industrial sector, we are looking at the index of industrial production, and we are looking at the quarterly number, that is the April to June quarter. And if we see April to June quarter, IIP growth as a whole came in at around 5%, but that was mainly powered by mining and electricity sector. So if we look at the IIP from the general economic classification, we have mining, manufacturing and electricity, but the bulk of the IIP is accounted for by the manufacturing sector. Manufacturing sector accounts for almost 78%. But growth came in mainly from mining and electricity. Electricity also because of the heat wave, there was an increased demand for power electricity. So IIP electricity growth was more than 10% in this quarter. IIP mining was also more than 8%. So these
For similar reasons.
For similar reasons,
Right.
yes. But manufacturing sector's growth was subdued at around 3.8%. So IIP manufacturing was subdued at 3.8%. And if we look at the use-based classification, which includes basic, primary, infrastructure goods and consumer durables, there we see that IIP from the use-based side was mainly driven by IIP consumer goods. But consumer non-durable goods production contracted. So we can get some inference about the demand side, that demand side is picking up because consumer durables did very well. The production of consumer durables did very well, but consumer non-durables didn't do well. So while demand is picking up, again, it is not broad-based.
Okay, and so now that's how the industries have been doing. But looking at corporate profitability, which is another metric of to see how the economy has been doing, last year saw corporate profitability quite high. They were doing quite well.
Yes.
Is that expected to continue or not?
So this in this first quarter, we are seeing some amount of correction in profit. So because, as you rightly said, there were extraordinary profits in the FY24. And if we look at the FY24, the last financial year, the corporate sector performance was driven by a kind of divergence. There was divergence between profitability and sales growth. So profitability was rising, but sales growth, the sales revenue was quite muted because demand was low. So profitability was mainly driven by a reduction in input costs. So that was driving the operating profits of firms in FY24. Now, in the first quarter, what we see, we have the data for the quarter, and it's a very useful data because it goes into the calculation of the gross value addition for manufacturing sector. For manufacturing sector, GVA, basically the CSO looks at IIP manufacturing and they look at the financial performance of manufacturing sector firm, which mainly implies looking at the profitability of manufacturing sector firm. And there we see that there is a correction in profits of manufacturing sector
because
firm.
Input prices have
because
gone up.
There is uncertainty associated with the input prices. But again, here we are looking at aggregate manufacturing sector and there's a lot of heterogeneity, there's a lot of variation. And the slide is again mainly driven by petroleum refinery companies. They are seeing a deceleration in their refining margin because of high input costs. So that is one. But again, if we look at consumer goods firms, they have reported healthy profits. So again, that's giving an indication that demand is improving. So there are some sector firms that have not done well in terms of profitability, mainly because there is a correction from the sharp spike in profits that was seen in the last financial year. And for some other set of firms, there is an improvement because of demand side. So basically food products firms and consumer goods firms, they did well this time because of recovery.
Right. And now this, obviously the GDP data comes out once a quarter, but there are many more high frequency indicators that come out on a monthly basis and some of them even on a weekly basis. So what are they showing about economic activity? Because that's a pretty good gauge of especially demand, how that's moved.
Absolutely. So various high frequency indicators get captured into different segments of GDP. For example, if we look at say commercial vehicles, we look at automobile sales, passenger vehicle sales, they all get captured in the services component, the trade, hotel, transport services component. And there what we see is that there is a sequential easing. That means from the March quarter, there is a decline in sales growth. There is a reduction in sales growth as compared to the March quarter. And again, firstly, if we say look at passenger vehicles, we see that there is a contraction in the sales of passenger cars. But there is again healthy sales for multi-utility vehicles and vans. So again, there is a mixed picture here. Also, if we look at commercial vehicles, there is an easing from March quarter, and that normally happens. There is a seasonality impact, and also this time again due to general elections and commercial vehicles get impacted if there is a slowdown in infrastructure projects because they are involved in transportation of raw materials. So because there was a slowdown in infrastructure projects, the CV sales did not pick up to an appreciable extent.
Right.
But even then, it was there was a positive growth, and it is expected to pick up in the July to September quarter, mainly because now there is a step up in government expenditure and also because of the onset of festival season. So that's the picture on high frequency indicators. Also, if we look at some others like PMI manufacturing and services, they have remained steady. They have been doing well. On some of the other indicators, if we look at say construction, for construction, CSO mainly looks at steel consumption and cement production.
Right.
Again, there is a mixed picture here because steel did very well, but cement did not do well. So overall, we are getting a mixed picture. But again, on the demand side, most of the indicators of demand side point to a revival in demand, be it from the IIP side or be it from the corporate sector side.
That's actually great news for the economy, because demand has been a matter of concern, and the question of when will the private sector start investing more and all of that, it's all pegged to demand. It's only when demand revives that the private sector will invest. So this is very good to hear. But speaking of demand, the real concern has been about rural demand.
Right.
And so now are we seeing that this category, because we know that urban demand and a particular category of urban demand, the more affluent people, that demand has been strong.
Right.
But has rural demand picked up?
Yeah. So if we look at some of the indicators for rural demand, some proxies, for example, two-wheeler sales, three-wheeler sales, we are seeing healthy growth, particularly for two-wheeler sales. But again, some part of this growth is driven by the fact that last year the base was very low. So on that, we are seeing a very high growth. But again, it is expected to pick up further because of better monsoon, because of increase in the MSP of Kharif crops.
Right.
There has been an increase in sowing of Kharif. Till 20th of August, sowing is up more than 2% as compared to 20th August of last year. So many factors suggest that rural demand is likely to pick up. And may have done better in the first quarter. And also another important indicator arguably is the financial performance of the fast moving consumer goods segment, which captures the mass market, not the class market, but basically the mass market it captures. And there we see a visible improvement in the profitability of companies in the FMCG segment. From around 4% in the March quarter, there is an improvement to 7.5% in April to June quarter. And even if we look at their analyst call discussions, they say that it's mainly driven by the rural markets, because there was a lot of price cuts and there has been an improvement in the volumes that are sold in the rural market, and they are focusing on rural markets. So they are optimistic that further as well rural demand will continue to pick up.
Absolutely. There's a lot hinges on the monsoon. So here's hoping that it continues its progress. But now another measure to look at both the investment intent and consumption intent is to look at bank credit and how that has grown, because companies borrow to invest and people borrow to buy things. So how has that grown?
So in the June quarter, bank credit slowed to around 13.9%. This is lower than the growth that we saw in the last financial year, which was around 16%, excluding the HDFC merger. So there has been a slowdown. But again, if we look at the early data that we get for July, there is again a pickup in bank credit to around 15%. But the key problem lies, as there's a lot of discussion, that there has been a sharp increase in the credit to deposit ratio, because deposits have been trailing credit growth because of number of factors, mainly because there has been a structural shift in the nature of household savings. They are mostly investing in mutual funds and also taking direct exposure to equity, that is why the deposits growth is not rising at an appreciable to an appreciable extent, and that could lead to either a war amongst banks to woo depositors by attracting by higher interest rate on deposit, and that could squeeze the net interest margin in the coming quarter
and their profitability of the banks.
And also we've already seen that happening in the first quarter, because if we look at the financial performance of listed banks, we see that the NIM, the net interest margins, have come under pressure, and credit deposit ratio has picked up. So this is something that needs to be seen, and going forward, that will have a bearing on the GVA of the financial sector.
Right. Okay. And so now, whenever we talk about GDP and we pose the question, we get a lot of questions from the audience. So this is one question which the person hasn't named themselves, but they say, as we saw, Indian exports dwindled a bit, but the imports rose by a fair margin. What would you associate this trend with? Is it the slowdown or recession throughout the world and that the Indian economy is still intact? Or is it that our exports and manufacturing haven't really caught up despite all of the PLI incentives and the investments in infrastructure?
So if again exports, we have to look at firstly the April to June quarter, and if we look at the trajectory of merchandise exports in the April to June quarter, there was a pickup in exports from last financial year, because we had a discussion on the export performance in FY24, and exports actually contracted in FY24 due to multiple factors. But in the first quarter, we saw exports registering a positive growth of around 5%. It was only in July. The question is actually related to the latest number, which is July. There we saw exports again contracting, and that was mainly because of decline in petroleum exports. And if we exclude petroleum and non-oil and non-gold exports, there was a positive growth in exports, and it was mainly powered by engineering goods and electronic goods.
But in any case, July is not in our consideration.
July is not
We're
in our
looking at April to
consideration.
June.
Yeah, but again, just to answer the question, it was mainly because of petroleum exports, and that was because one, there has been an increase in domestic consumption, so less was available for exportable surplus. But going forward, yes, export hinges on what happens in the geopolitics and what's happening to the external demand. So that will continue to be conditional upon that. But at least the first quarter was positive for export growth, mostly both exports of goods as well as services.
All right. And Naveen asks, or he says that the economic survey is cautious and conservative in projecting GDP growth at 6.5 to 7%, as you had pointed out. With the monsoon continuing to be uneven, can we still be optimistic that GDP growth can surprise us in the same way it did in Q4 of last year?
Yeah, so on surprise, we can't say much because there are various methodological nuances that we don't understand. But just by looking at the trajectory of the various high frequency indicators that go into the computation of GVA, we can make some assessment. Now, coming to the question, economic survey projected a 6.5 to 7% growth, mainly because the survey opines that private investment will be lower in this financial year because of maybe cautious because of cheap imports from other countries. So that was the underlying assumption behind having this cautious projection. Otherwise, a medium-term projection is 7%, which is in alignment with what the IMF says or what the RBI says. And if we look at the first quarter, as we've discussed, there is a mixed picture, but consumption is likely to pick up from the lows of FY24. But manufacturing sector may not show a sustained growth, mainly because the two variables that go into the GVA of manufacturing, they did not show a strong growth. There is mostly a correction. It is normalization, and that's the problem with the year-on-year growth. So that is what I would have to say on this.
Okay, and now Mridul has a very vast question. They ask, could you take us through how exactly GDP is calculated in India? What are the problems in the current procedure? Also, what's your take on people like Arvind Subramanian saying that Indian GDP is not growing at 7%, but that it's actually growing at 4 to 4.5%.
Yeah, so this will require a full episode or maybe 2 episodes to
Right.
decipher the, how GDP is constructed. From the quarterly side, it is different. From the annual side, it is different. And then when the base year was changed, what all problems
Right.
came across. But just to be very brief, giving a brief overview, quarterly GDP is constructed using what is called a indicator-based approach. So if you look at the manual on MOSPI, the manual by Ministry of Statistics and Program Implementation, they give a very nice table on what are the variables that go into the construction of various segments of GVA. For mining, what are the things that they look at, for construction, for manufacturing, and so on. Now, when we come to annual, we know that there are various iterations of the same GDP. We have advanced estimates, then we have provisional estimates, we have revised estimates 1, 2, and 3. And at each time, the set of indicators become more refined, and therefore we get more robust data, more robust set of information, because the advanced estimates are just based on 9 to 10 months of data, and rest of it is extrapolation. Provisional, we have one set of data. When we go to revise, we also look at informal sector, and we look at some of the surveys of unincorporated enterprises. So the information set widens. So I'll stop here, because again, we can
just go on about this.
Yes.
Right, and about the Arvind Subramanian's estimation.
Yeah, again, that is based on the methodological debate that arose when the base year was changed. Because when the base year was changed from 2004-5 to 2011-12, there was a lot of changes were made to the indicators that go into the construction of GDP, and that was the reason that led to this debate. Because at that time, GDP was not aligning with a number of other, typical high frequency indicators that we look into. And on that basis, there were these claims that, actually GDP is 4.5%. But I think when you have changed the methodology, you need to look at the revised set of indicators.
Right.
So that debate is still going. It hasn't
ended. Of course. And if you want to get a full kind of roundup of it, you should read a lot of what was written around 2015. 2015-16 is when a lot of these discussions, it was a really hot topic. There was a lot written at the time, so you'll get a lot of insight there. But there you go. That's your little snapshot of what the economy looked like in Q1. I'm not going to go into each of the metrics that we talked about. There are a lot, and each of them seem to be pointing in conflicting directions, sometimes in the same direction. But that's what we have for you in this episode. We look forward to the actual data coming out next week. But thank you so much for watching.